European markets ended the day lower on the renewed tension. In Germany, the DAX 40 closed more than 1.4% in the red. There's fears that the energy-intensive export economy is especially vulnerable if the Iran conflict drags on. The London's FTSE 100 ended the day just over 0.4% lower. Oil majors BP and Shell among the stocks pulling that index down. And in France, the CAC 40 down just over 1%, dragged lower by luxury stocks as investors worry that higher oil prices could hit consumer demand. But in the United States, the S&P 500 and the Nasdaq reached record highs on Friday, driven by gains in tech stocks and stronger than expected jobs growth. The economy added 115,000 jobs in April. The unemployment rate remained steady at 4.3% despite an uncertain outlook from the Iran war. Economists have warned it's too early for the effects of the conflict to be fully felt. Well, let's speak now to Fiona Cincotta. She's an analyst with finance broker Citi Index. Hello, Fiona. So, Wall Street's looking good, trending higher. Give us your breakdown of what you think is the most important driver of that.
Yes, so I mean, there are a couple of factors. As far as importance is concerned, I think it's difficult to really be able to distinguish. But, you know, we've just had a very encouraging earnings season, which is really, particularly from tech stocks, we've seen semiconductors, chips performing well. That's really helping that AI trade be revived. Then on top of that, we've got solid data coming from the US. So as you mentioned, the non-farm payroll report, the closely watched timely jobs report, was significantly stronger than expected. A second straight month of very solid jobs gains, showing that the US economy is actually holding up, or the jobs market specifically is holding up particularly well despite the conflict or the confusion over what's going on in the Middle East. And then on top of that, we've got that sort of optimism of that deal between, or a potential deal some point between the US and Iran, which has pulled oil prices down around 6-7% this week, although they are up a little bit today. Across the week they have fallen, which is just reducing inflationary worries.
European stocks looking less rosy than the United States. What do you put that down to?
So again, there are a couple of factors here. I mean, we know that Europe is more reliant on imported energy and is therefore more vulnerable to spikes in oil prices, energy prices. So any hints or warnings or fears that, you know, there might be an escalation again between the US and Iran is going to be felt more intensely in European markets. And then on top of that, you know, we've had European earnings season. It's been okay, but it's definitely not as good as what we've seen in the US. So again, that just means that investors are sort of shifting away from Europe and putting their attention onto the US.
Oil is still bouncing around $100 a barrel. If we see solid progress on a deal, and we know that Iran is looking at the latest deal, if the Middle East tension starts to ease, where do you think a realistic price for oil will be? We spoke yesterday about this, and you said you don't think it's going to go back to where it was.
No, that's right. So, I mean, even if we did see, you know, a deal this weekend and the Strait of Hormuz reopen, it's going to take time. There's also been damage to oil infrastructure in the region. So, again, that's going to take time for things to ramp up, for refining to ramp up and production to ramp up. So I do think we would see some of the risk premium removed from the oil price, which would bring it back down from $100 a barrel. But potentially, I think we could be looking around the $85 a barrel region once we see the Strait of Hormuz reopened and ships flowing. But that's up from that sort of $60 a barrel where we were prior to the war, just because there will continue to be that sort of concerns over supply until they're back to normal, which could take several months.
Thank you so much, Fiona Cincotta of Citi Index.